It's amazing to be here now, 15 months after the last ECAP, and the energy, the positive energy that's going on. You know, it feels like last ECAP, and even better. You would never know that what the operators have gone through over this past year, and what type of stress they've been under from an operational standpoint, from an uncertainty on a financial standpoint. And you know, we forget what March, April looked like, and the uncertainty that we had then. Of course, there is some uncertainty looking forward, but what we'd like to try to accomplish today, you know, it's three packed topics, but we'd like to at least, you know, review some of the large stimulus programs that really, you know, literally saved our industry, and try to focus in on, you know, high level what are these programs, and what should people be thinking about at this point in time. When we were going through that uncertainty, there were a few pillars of clarity, pillars of light that helped our industry understand, navigate what in the world is going on. PPP, they're running out of money. What are the rules? Am I eligible? Am I not? How do I get it through? The banks didn't know what was happening. What kind of opportunities are out there for me? So there were really three, you know, these three people that are here were really a tremendous guidance for our industry. And I think it's an honor to be here and to have them share some of their wisdom. I'd like to break it up into three parts. I think we're going to talk about PPP, and we're going to ask Zecharia to take the lead on that. And we're going to talk about the HHS CARES Act provider relief funds, and we're going to talk about the employee retention credit. So let's start with PPP. In April, when, you know, I remember the homes when the pandemic started, and certainly on the East Coast, the homes were being ravaged. Nobody had any idea. People were very, very nervous about how in the world are we going to survive this. And thankfully, the CARES Act came out, and the first large stimulus program that hit us was PPP. And at the time, like we said, tremendous confusion. There was also a lot of concern that they would run out of money. They had allocated the $350 billion or so for round one of the PPP, and everybody knew there's going to be a run on that money. And a real kudos to Zecharia and Roth&Co for, in no time, setting up an advisory team that was an unbelievable pillar of clarity and calmness. Meaning, as people were going through and were really anxious about it, your team was really unbelievable for a lot of our clients and a lot of people in the industry. I'd like to ask you to just give us an overview of the PPP programs, and then we'll get into some specific questions.
So I got the honor to talk about PPP because it's pretty much dead, and there's no more applications, and there's no more money. But I'll do the best. So on a high level, PPP really kept businesses, obviously your businesses, but businesses afloat, and ensured that people will continue getting their paychecks. That was the purpose of it, and I believe it really accomplished that. The results, I think, the results of that kind of infusion and that kind of stimulus, I don't think we really know yet the results on the business. What I am seeing, almost immediate results, is that businesses, again, in the nursing home industry as well as other businesses, where they're competing on salaries because people are not exactly thinking about that extra $5 or $2 or $3 an hour, and then suddenly there are people, lots of people who are going collecting unemployment or don't want to work now or have other sources of income for now, and then whoever is out there and is left, there's kind of a competition of potentially paying way above market value or creating a new market value. So we're kind of seeing that, and I think it might be getting a little bit worse when it comes to that. But hopefully it'll straighten out in the near future, and it'll be able to settle into some kind of market rate. So there's a few parts. We're going to get into details of the affiliation rules.
Let's get an overview of the basic parameters of what made people eligible, PPP1, PPP2.
Okay, so PPP1 was way back when they passed this emergency bill, and pretty much everybody in a very small criteria, meaning to say very easily eligible in terms of the amount of employees. There were some affiliation rules for employees. There was a need to document the uncertainty at the time, and then you were eligible for the PPP. That was PPP round 1. PPP round 2 was a little bit more complicated in terms of eligibility because we needed to have a drop in revenue compared to the prior year, compared to 2019, a 25% drop in revenue. And the employee count changed, so there were some changes that kind of tightened it a little bit, or more than a little bit, for people who are really, really being hit, and not just that uncertainty. I must say that it was pretty efficient. I mean, the SBA in the beginning, it was kind of unknown, but once they got their act together pretty quickly, and they started dispersing money to almost anybody, and as time passed, it started getting a little bit more difficult, or a little bit more backup. The banks were asking more questions, but in the beginning, it was just you sign the papers, and you'll get your money tomorrow. To a certain degree, because of the whole situation, and you're saying we set up a team, and we did set up a team, but that was pretty much everything we did in those 2 months. Nobody wanted to do any tax or audit work. I'm sure Kuno can agree to that as well. So that's pretty much everything we did. So we really had no choice, but we did mobilize and really helped all of our clients really process this and navigate through this smoothly. And the same with now forgiveness, which is not as much of a rush, but really working through that now.
So, in the interest of time, I think being that the program at this point, officially ends 5/31, and the way I understand it is they're out of money. But at this point, companies should be starting to think about forgiveness. Can you talk about what people should be thinking about before they go for forgiveness, or what type of documentation should they be thinking about having, considering that the SBA has indicated that they would be auditing any loan over $2 million?
Okay, so as time passed, they kind of clarified the forgiveness rules specifically related to the covered periods. In the beginning, they were saying 8 or 24 weeks. Now it's pretty much anywhere between 8 and 24 weeks that you can disperse and spend the payroll money. So it got a little bit easier. Obviously, we understand a lot more of the criteria of forgiveness, but pretty much is when you spend the money, after you spend the money is when you go for forgiveness, as long as it didn't exceed over the 24 weeks. And obviously, I think it's almost impossible for it to be less than the 8 weeks. Kuno is going to talk more about that when it comes to the retention credit, but you do need to be smart about that. If you're eligible for PPP and for the retention credit, to make sure that you use the amount of weeks so that it can work to be able to maximize the PPP as well as the retention credit. There are some differences in terms of terminology, affiliation rules versus aggregation rules, kind of, PPP used affiliation rules, there are some similarities. Again, if it's relevant, Kuno will discuss the aggregation rules, but the affiliation rules was a big deal. Basically, if you own any other businesses, which kind of combined would be more than the 500 or 300 employees, then you wouldn't be eligible for the PPP. Besides, the biggest difference between affiliation and aggregation is that the religious not-for-profits, which is almost irrelevant here, are exempt of the affiliation rules, and not necessarily exempt of the aggregation rules. The FTEs, okay, so the FTEs in terms of the PPP, FTE would stand for full-time equivalent, which would be based on a 40-hour week, and the ERC is a little bit different than that. So there are some differences between the PPP and the ERC. In terms of forgiveness and documentation. So originally, when and if you took the PPP-1, you needed to document the uncertainty, and if you documented, for yourself, you documented, or you knew that you were eligible and there was an uncertainty, which pretty much, I believe, almost everybody was. If you took less than $2 million at the time, then you should not have any issue of getting your forgiveness done. We've done many, and it's pretty seamless. I mean, it gets submitted, and within days, you should be getting notification that they've been forgiven. Over $2 million is at this point, the SBA put a freeze on all the forgiveness of over $2 million because they're looking into a lot of the issues before they continue that forgiveness. Now, you don't have the same issue. So for argument's sake, if you took, $1.9 million PPP-1 and then another $1.9 million in PPP-2, the SBA said they're not combining the two. So it's combined, even if combined is more than $2 million, they are treating it as separate. So you don't have the issue of, as a combined over $2 million, where you need to have additional documentation and additional proof of the uncertainty and the need. Now, we've been handling many of these SBA PPP audits for over $2 million. There are three key things that they're really looking at. Number one, obviously, was the loan amount calculated correctly? So in the beginning, like I said, it was just very easy. You submitted a number, they gave you the loan, and you were good to go. Now they're going back and they're taking a look to see if you actually calculated everything correctly. Was everything done properly? Based on the criteria and based on the requirements. The second thing they're looking into is they're looking very seriously into the affiliation issues. So they're actually searching Social Security numbers and see how it matches to other entities that are associated with that Social Security to determine if you actually disclosed all your affiliations and you actually calculated all your affiliations. So that's number two. And the third thing they're looking at is the eligibility, that uncertainty, that need. So what are they looking at? Now remember one thing, that uncertainty was at the time that you took the loan. It's not today. If it turned out that you're doing better than you expected, that's fine. That does not change the forgiveness eligibility. But what they're looking at is at the time when you took the PPP, if you actually had that uncertainty. Now they're looking at things at that time. If you had a lot of liquid cash, if you had a good cash flow, they're looking at P&Ls and balance sheets. So that doesn't mean if you have liquid cash doesn't mean you weren't eligible, but you need to have the documentation. So when you submit for forgiveness over $2 million, so they right away request a form, detailing the eligibility and the uncertainty to be submitted. It has to be submitted within 10 days. So I really recommend that everybody, before you actually submit for forgiveness, have that documentation in place so that you can right away, when they request it, right away respond to it. Specifically in the nursing home industries, we've been really writing up detailed narratives, exactly documenting the need and the uncertainty. Because, again, like I said, it has nothing to do with what the end result was. It has to do with when you applied. And really, really prepare that narrative and prepare those details before you submit for forgiveness.
Thank you. Thank you. That's amazing. So I think the one key point is that the uncertainty had to be at the time of the application, not necessarily today. If somebody got HHS money and is maybe a little bit more comfortable today, that is okay.
Right. And in general, like, the nursing home business is a business like any other business. I mean, everyone has their own challenges, and we've been going through those challenges, with what's going on, and it plays out differently with everybody, but but it's a business, and the results of the CARES Act and the stimulus, there's going to be good, and there's going to be some challenges coming along with that as well.
Okay. I'd like to jump over to the provider relief funds. It's interesting, last year at ECAP in February, just a few weeks before the pandemic broke out, there was a panel discussion, which was really an amazing discussion with Mark Berger and David Hartman, Bobby Hartman, and Norma Rokeach, and Ronnie Wilhelm. And they were talking about how critical it is to create those relationships with your government leaders before the problems break out. Because once the problem is there, you have to tap into a relationship that's been in place before. And who would have believed that, a few weeks later, we'd be tapping into tremendous lobbying efforts by AHCA on behalf of our industry. And, I think that having AHCA with Clif, lobbying on our behalf has really been a tremendous savior for our industry during the pandemic. So I'm gonna just go back and ask you, to give us a quick overview of what happened till now with the provider relief funds, and then maybe we'll talk about what to expect going forward. So, what did they give us till now?
Yeah, it is great to see everybody. Let me not understate that. I made my way here, and lots of hugs and handshakes, and I was rushing to get here, but it is absolutely phenomenal to see everybody in the flesh and to touch you again. So I don't want to understate that. Again, great to be here with you, and thank you for the accolades. I think, again, as it relates to our efforts, half of it's preparation, half of it's just good fortune. And I think when we look back, I said I'm going to write a book about it one day, because it was amazing to watch the entire situation unfold, particularly from the elements of uncertainty, how the government responded. One day I'll write a book, but it was really interesting. So I think if you look at sort of where we start to where we are, the Trump administration took what I consider to be, while imperfect, the most intelligent business approach to dealing with a pandemic like we just had, like we're still dealing with, frankly. And I use the analogy of Hurricane Katrina anytime I'm advocating for our sector. And, Hurricane Katrina hit the entire Gulf Coast, but nursing homes were the 9th ward. And it's just that simple. There was no sector in healthcare impacted in the way that nursing homes were. And that's just a fact. And the realities of that impact were such that we had to literally, in our government affairs parlance, we normally say, you got to break the glass. There's sometimes you nuance relationships, you call, I'll see you at the next conference, I'll see you, let's schedule a meeting. There are other times when you just break the darn glass. And that basically means, folks that know me, I always say, do you have a relationship with your member of Congress? Folks say yes. My next question is, do you have their cell phone number? And if you don't, guess what? you kind of have a relationship, but not really. You need to have their cell phone number, because if you have their cell phone number, that means when it is time, as you said, to reach out and break the glass, you can. So we did. We were shattering some glass, folks. It was really, really scary. But we basically went through every level of the government up to the Trump administration. We had a conversation. And if you recall, the first round was what I call a Medicare fee-for-service round. They just looked at Medicare fee-for-service days, distributed resources. Didn't matter what provider you were, you got a round of money. We had nothing to do with that, meaning we were asking for relief, but how it was administered was as much a surprise to you as it was to us. But it was very, very helpful, particularly getting that oxygen in the atmosphere immediately. Now, again, you've got different states that were impacted in different ways, some more generously than others. You know, I think about the state of Oregon, that is mainly a Medicare managed care state. They didn't get the same benefit as those that were mainly Medicare fee-for-service. So there were some disparities, but again, the tactical decision, what do I need to do to get oxygen in the atmosphere now, right? No forms, no portals, oxygen now. And that's what the administration, the step they took. Another phase that was kind of underappreciated because it didn't impact us as much was a Medicaid-only phase. Now that's not even really even recognized, even in some of the government publications as it relates to rounds of funding. But immediately upon that Medicare fee-for-service round, you know, obviously if you were Medicaid only and you don't have Medicare, you were screaming, right? You had nothing. So between those folks, which wasn't you know, again, a huge number of operators, but obviously developmentally disabled facilities, those kind of institutions, desperately needed help. So that was more or less round two. Now, from there, you know, sort of behind the curtain, look at this. There's this one guy who was sort of responsible for being the liaison, and literally, you know, I have his cell phone number, and we're talking every night. And he's trying to figure out how to get this money out the door. That was his job. And as is classic with everything relating to our government, he's about 28 years old. So, you know, you laugh, and these folks are, you know, pretty high levels of responsibility and pretty young. But really, really sharp young man. And he was working with us night and day. So from there, it was really about us amplifying this skilled nursing story, which is what we were doing. And that whole Ninth Ward analogy that I've used. And it was like, look, we need more help, and we need it now, and we need it to be specific, and, you know, or it's going to be lights out. And that was the most beneficial round, which was what we call the sniff round. That was a per bed. The nice thing about that, and we kind of got better as time got along, we crafted that basically. We gave them the idea of how to do it. We vetted it with our members, said how is the best way to do this quickly. We developed a plan, and we sold it. And basically they adapted what we recommended. So that was, you know, $5 billion. Now keep this in mind. I mean, you know, I always say, you know, and I've been in this business for 32 years. I started running a 34-bed nursing home. Alan Zecharia may or may not be in the room, but that's where I first met Alan when I had I always tease folks and say I had a Will Smith haircut then, you know, like the Fresh Prince. I had a lot of hair, about 24 years old. And, but, you know, again, when we look at sort of where we were as a sector over all these years, we got billions of dollars in a matter of months, which told me a couple of things. But the main thing that it did tell us was this: our government was not going to let us drown. They viewed us, you know, as frustrating as it is, and screaming about Medicaid margins, and fussing about being underfunded, and fussing about regulation, and feeling ignored. When the rubber met the road, they made a decision that they weren't going to let us go. And they could have. They could have let us go. They could have ignored us, and we wouldn't be in the same position that we're in right now. So again, when we think about sort of cumulatively what transpired, we were then in a position to sort of get a little bit better. So we get this sniff round. And then from there, the next was this, what we call quip round. Now this one had nothing to do, I mean, we talk about our input. This quality improvement round was all their idea. And we frankly tried to talk them out of doing it that way. Because in theory, if you think about it, how are you going to do quality improvement anything in the midst of a pandemic? I mean, that's like, saying we're gonna measure quality improvement in the middle of a hurricane. I mean, you can't. I mean, it's a disaster. It's impossible. It's ridiculous almost. But again, it was sort of this favorable policy idea, so we had to more or less massage it in a way that was most beneficial because we weren't going to change their mind, right? So we were able at least to tweak how it was done and at least position it where everybody got something. It wasn't the most equitable of all of the programs that we basically received, but again, it was another round of funding. And then lastly, we're at this phase 3, phase 4 stage. Phase 3 to me, and again, this was initiated at the end of the Trump administration, but they applied this alternate method cap that made that particular round of funding largely not helpful for a lot of us. So now we've got phase 4. It's about $24.5 billion left in the fund. And then there's another fund that we're not calling PRF, so don't call it PRF. Just call it the Rural Fund, okay? Because they're going to manage that completely differently. But the PRF fund, the $24.5 billion left, the intent is to empty that out with phase 4, which will be another portal process that is allegedly going to be, the portal's allegedly going to be announced. Kuno, as soon as I hit the stage, I got one question for you. The whole way is one question, which was phase 4, right? And again, and I threw it back at him. I said, "You tell me." They're telling us late May, early June. That probably means mid-June. But that's what I'm being told. And I think now the real effort for us on the fund side is to ensure that that alternate method is not applied. Because at the end of the day, it is a game of averages with that method. And if you're in New York and you have a 500-bed facility, you're way above average. So you're automatically going to get, your relief knocked down, if not eliminated. And there are a variety of other factors that can come into play that could disadvantage you. So we're working to eliminate that. Bottom line is, if you're underwater, if your expenses are up, if your revenue's down, if there's a delta, that's what the fund is for. That's what you should be able to use it for. So lastly on this, we're working to move this date, so on reporting. I feel very good about that being moved. When that will be moved to, I don't know, but I will say that I anticipate that it will be at least to the end of this year and likely beyond that. But we're being told from a variety of sources that the reporting deadline will be moved, and I have a fairly high level of confidence that that will be the case.
Okay, that's great. I mean, we're now at the end of May, and a lot of the operators are starting to think, did I expend my funds? Have I it's coming up to June 30th deadline, which officially we're going to have to is the end of when we can spend it. You think in the near future we'll get some kind of an extension? Yeah, I really do. That message has been loud and clear. So, a couple things, it's funny, and it applies in every state house too, but, when you have people that are making decisions, the key is to get the folks that give them money to ask them questions, get them to lobby on your behalf. So they had a hearing with the HHS, Energy and Commerce. They had a hearing with them, and they approved a lot of HHS's budget, right? So we got Congresswoman Eshoo from California
as well as a couple other members of Congress, to ask Secretary Becerra and tell him, you got to move this date. This is important and why. And are you going to move the date? So he's writing, and he's writing, and he's writing. But, you know, it's almost an implied kind of message, you know, this is important to me, and you're here asking me, you know, for a budget. I need your help. And again, I mean, if you think about it, it really has no bearing whatsoever on the Treasury at all. It's just a matter of making sure the money does the work that it should. So I feel pretty good about. We got a lot of advocates pushing for us in that way.
Okay, excellent. I'd like to jump into the ERC credit, because that's something that's very active right now, and you know, if time allows, maybe we'll get even a little bit more detailed. Before that, I just want to highlight the fact that one of those firms, those professional firms that jumped into creating an advisory team, jumped into being that clarity within the hurricane was Pease, Pease and Associates, led by Kuno, and so many of our clients have realized opportunities and gotten clarity from your group. So thank you for that. Can you give us, Kuno, a high-level overview of the ERC program? How has it evolved from 2020 to 2021? And just give us a high-level overview of that program, please.
All right, so just when we thought the craziness of PPP and stimulus was over, we got hit with this ERC thing at the end of the year. And when ERC was initially enacted as part of the CARES Act, it was limited to a one-time $5,000 credit limit per employee, and you were not allowed to take it if you also took PPP funds, which basically eliminated every skilled care provider in the country that got the PPP funds. The original version of the credit only applied if you had less than 100 employees in 2019. 2019 is always viewed as the baseline year for all of this because that's the last normal year that we were in business. So the references are always to 19. But you needed to have less than 100 employees in 2019, and you needed to have a 50% revenue reduction compared to the same quarter in 2019. And again, with the interaction with the PPP money, nobody went for the credit. So then at the end of the year, as part of Stimulus 2, they put in this little nugget that they are going to extend the ERC through the first 2 quarters of 2021. The credit would be available to anybody who had less than 500 employees, AHCA employees, that is, in 2019. And so the credit then was set at $7,000 per quarter per employee. So at $7,000 maximum per quarter per employee, that makes the money that's coming out on the ERC right now significantly larger than the PPP for a lot of my clients. For somebody with 500 employees, that would give them $3.5 million per quarter, which is taxable, by the way. So we're creating a tax problem that people are going to call me about at the end of the year, and I'll gladly work on.
So can I ask you a question before we even jump into further detail? This is significantly more money than the PPP program?
It is, yeah. I'm seeing, and it depends upon how far into 2021 that we get the credit for the homes. But yeah, it's if we get it mid-year, it'll be a little bit more than PPP for most of the people I've been working on.
Do you have any insight on how the government works like that? I mean, the PPP, they first gave 300-something billion, and then they added another 300 billion, and then it got capped, and they ran out of money. This could be significantly more than that. Where is this money coming from?
Our grandchildren. The Chinese grandchildren, I don't even know.
Okay.
God knows. So then in the second stimulus, they extended it through June, and then here in March, they extended the credit through the end of this year. So when you go for the credit, the most important qualifier is the number of employees that you had in 2019. When you look at the number of employees, you're not looking at FTEs, or in the case of PPP, you counted every single person that worked for you that year, even if it was 1 hour. For these purposes, it's AHCA employees. Those are people who would qualify for Obamacare insurance. Your payroll providers will give you reports typically as to how many AHCA employees you have. So if you had less than 500, and most of what we did is for 2021 because the money was so small for 20 and the size limits. So let me just talk 21. But so the the ACA employee count is something that's available to you. And if you had 500 in 2019 and you have 5,000 today, great, you qualify. I mean, the code is written on the ERC that you just refer back to 2019. And for an industry like the skilled care world where people are buying up homes rapidly and rapidly growing, you know, I'm seeing a lot of cases where somebody had 200 ACA employees in 19 and today they've got 3,000 in the one case. So, you know, and there you're talking 7,000 times 3,000 is 21 million per quarter. I mean, maximum. Nobody actually gets it that high, but anyway, the credit is immediately refundable. You can get the refund in a couple of different ways. You make smaller payroll tax deposits as you make your deposits. And then if the credit is larger than your missed payroll deposits, then you file a 941 and you get you get a refund check back. I've had a lot of my clients get their checks. It took about 3 weeks and I sent them through the mail. For such large dollar amounts, I was anticipating that they would do more electronic transfers, but people are getting the checks in the mail. And it's taken about 3 weeks after they file the claim. If you haven't filed the claim on your first quarter 941, you have 2 years to amend that tax return, and you get the money back. And last but not least, in anticipation of getting the credit, there's a form you can file projecting how much credit you would get this year, and then they'll send you a check for that, which I think is a problem for the industry to do that. But
So you're saying technically if someone was 200 employees in 2019, 3,000 employees by the end of 2020, they're just going to look at the 200 employees of that controlled group, and they'll be eligible for the full group of credits.
yes, and it works the other way for businesses that had 2,000 employees in 19 and they shrank for whatever reason, and they're under 500 today, they don't get anything.
So let's just talk about that scenario for a minute. Those homes that took over, you know, had a child process during 2020, so they're going to compare to old owners 2019 in order to determine their revenue reduction, whether or not they had a revenue reduction. Are they going to compare to the old owners Q quarter in 2019?
Yeah, the way the code is written, if you have an acquisition in 20, when you do the credit in 21, you actually use 20 as your base year instead of 19. Some people are saying you could read into this that you can look at the old owner's information. I haven't seen any support for that. But if you buy a home in 20 and you have a group of homes you've already owned in 19, I'm making sure to tell people, or in 21, more importantly, to tell people to make the ownership on those new acquisitions the same as something that qualified for 19, and then it folds into that controlled group, and then you qualify. So, you know, don't be a victim of bad planning.
So can you give us the general criteria of the 500 employee controlled group? What defines a controlled group? We know it's different for SBA PPP purposes and for ERC. So
yeah, for PPP, control group or affiliated group was their terminology, was anything where you had control. They didn't care about actual ownership. They were just worried about control. For the ERC, a controlled group exists, and you have to do this very carefully when you read this. A control group exists when you have the same 5 or fewer individuals or trusts or corporations owning 80% or more of multiple companies. Okay, so if you have several companies and you have exact identical ownership at 5 or fewer people at 80%, they all get rolled into one. If you have a case where you have a 21% or more unique owner on a company, then that can't be a control group with something else because they don't hit that 80% mark. So when we're looking at people's stuff, the easy thing is to just simply find a case where you have a 21% owner that's unique to that company, and then that's a standalone. I've got a client group that's this crazy combination of brains and good luck. The guy's first initial is F. I'll let everybody guess at the rest of that. They have homes in 3 or 4 states, and each one of those has a 25% local operator that owns just that state at 25%. So while all of them together are a huge group, because they have a unique 25% owner in each state, you know, all the states are actually treated as separately, and the whole group qualified.
amazing.
So, but when you look at that, there's, it's important when you do this stuff not to ever know anything in advance, Because when you look at this, brothers and sisters are not related when you determine ownership, and parents and children are not related if the children are over 21 years old. So you run into cases where everybody thinks, well, my family owns it, therefore it's a controlled group, but it's actually not. So, you know, it's worth the time to actually look at it and see what you have.
I want to get to the partial suspension rule, but before that, let's just quickly, one of the rules is that you had to have a 20% reduction in revenue. So one of the questions that we dealt with on a number of occasions is the provider relief funds or PPP forgiveness, if I get it in 2021, in a quarter in 2021, is that considered revenue for,
Yes,
for purposes of?
I firmly believe that's revenue. They refer to the Internal Revenue Code definition of revenue, and I think both of those would be revenue, and even though the PPP is tax exempt at the end of the day, it's still revenue.
Provider relief funds, would it be the period that you got the funds, or would it be a period that you earned the funds, which means that you add expenses to earn it?
The period that you earn the funds, because you're going to book it in as a loan and then pick that up as income as you earn it, whether or not you're cash or accrual method. So it's the period that you earn it.
So let's talk about this. I mean, you were at the forefront of pointing out that skilled nursing facilities, even if they don't qualify for the revenue reduction, even if they had less than a 20% revenue reduction, may very well be eligible for this credit because they've had a partial suspension that had more than a nominal effect on their business. Can you give us some criteria to understand what constitutes a partial suspension that had an effect on our business? What doesn't?
Yeah, so to qualify, you can have either the revenue reduction or you can show that your business was either fully or partially shut down. In the IRS's opinion, a partial shutdown occurs when 10% or more of your capacity to do business is impaired. And restaurants are such an easy example, so the IRS always cites or gives restaurants as examples. But in the case of restaurants, they said that local regulations required the restaurant to spread their tables by 6 feet apart. And in doing so, they lost 10% or more of their seating capacity. So if you look at that and you start thinking about the world that we deal with, when you admit a new resident, you needed to, and for a while still, will need to quarantine them. So if you quarantine them in a room that has multiple beds in it, then you've taken that second bed offline, which is an impairment to that bed. If you have a Corona wing set up where you're limiting the people in that wing, all the empty beds are being impaired by government regulation. And government regulation extends beyond what has actually been enacted through federal, state, or local. Government regulation includes CDC recommendations. So as long as there's a recommendation that we do these kinds of things, then that will qualify. The easier ones were the states where they had complete bars on admissions. I mean, without a doubt, you're impaired on all of your empty beds in that case. So the credit is available to people, and this is kind of like looking at 2021. The credit was extended through the fourth quarter of 2021, but if you're dealing with impairment as your justification for the credit, you can only get the credit for the period for which you're impaired. So if on July 15th somebody says it's over and we have this crazy mass burning party nationwide, the credit would stop at that date. If you're getting the credit due to revenue reductions, then, which I haven't seen much at all, so I'm not sure the right answer to that. But if you're doing on revenue reductions, then you get the credit for the whole quarter plus the following quarter. But again, that's not been real common from what I'm seeing.
So I know you've been at a lot of, some people have been going for legal opinions, or legal memos on this. Can you give us some kind of a criteria? When do you think a legal opinion is helpful or warranted, or what would be the objective of that legal opinion?
Yeah, money's all fun and games until the IRS comes to your office, and then it gets to be a little more serious. So, this is a tax position, which means that if you can show reasonable reliance on a tax professional, then they cannot assess you a penalty. So the worst thing that could happen to you on audit is that you're forced to repay the tax plus interest, but no penalties. And in this area, there's some harsh penalties potentially. So to show reasonable reliance on a tax professional, all you need to do is just show that you did appropriate homework for the level of dollars involved. And for these levels of dollars, I'm recommending to everybody that they get a memo from a law firm. We could do it too as an accounting firm, but I like to credit too much, so I'm referring them to a lawyer for more of an independent view on it. But anyway, so you get that memo, it's $8,000, $9,000, $10,000, and if you measure that to a penalty potentially, it's probably the cheapest insurance policy that you can ever buy. It gives you peace of mind, you can sleep at night, you know. The question is going to be, as the facts keep changing here, because these memos are very fact specific, as the facts keep changing and these restrictions are lifted, you know, are we going to need to refresh the memo in light of what restrictions are in place in a subsequent quarter? So, which is slowly but surely happening on a daily basis.
Understood. So because we're you know, there's so many details in all of these programs, and I'm sure this is going to continue to evolve. You know, we're just touching on the tip of the iceberg over here, trying to get people thinking about, you know, what they should be thinking about, and obviously, as you get more detailed or you have specific cases, I would strongly encourage that you reach out to the people on this panel, and if we can't get the cell phone numbers of our government officials, maybe we should get Clif's cell phone number. So at least that, let's be in touch with the people that could get us through this. I expect that it will continue to evolve. We will continue to have some confusion, but we as an industry are lucky to have the three of you guiding us, and we look forward to further success together.
And we're lucky to have LTC.